Hi guys and welcome back to the Mindful Investing channel. Today I want to talk with you about Apple, ticker AAPL. Apple is down almost 13% year to date. So let's have a look at Apple, value the company and see what kind of investment returns we would be able to achieve if we were to invest right now. As always, let's value Apple using our simple discounted cash flow model. To be able to value Apple using this simple discounted cash flow model, we have to first make a couple of assumptions. First, we have to assume Apple's free cash flow growth rates for the next 5 years and for the 5 years following those 5 years. We also have to assume Apple's price to free cash flow multiple at the end of our 10-year holding period, as well as Apple's buyback yield over our holding time. So let's begin with our assumptions for Apple's future free cash flow growth rates. Personally, I like to base my free cash flow growth rate assumptions on Apple's historical free cash flow growth rates. When we calculate Apple's compound annual growth rate for their free cash flows based on the last 5 years, we come up with an annual free cash flow growth rate of around 11.7%. Because I always want to be conservative in my assumptions and to factor in Apple's free cash flow drop in 2015, I only assumed a free cash flow growth rate for the next 5 years of 8% and a free cash flow growth rate following those 5 years of 6%. Next, we have to assume Apple's price to free cash flow multiple at the end of a 10-year holding period. If we look at Apple's historical price to free cash flow ratio over the last 12 years, we see that Apple most of the time traded somewhere in the range from 10 to 20. Because I think that Apple currently is a higher quality company than it was, for example, in 2015, I think that a price to free cash flow multiple of around 15 at the end of our holding period sounds reasonable. But we also have to keep in mind that Apple's future growth potential is definitely lower now than it was in, for example, 2015. So this acts as kind of a cap on Apple's price to free cash flow multiple. Next, we have to assume Apple's annual buyback yield over a holding period. Like with our growth rate assumptions, I like to base my buyback yield assumptions on the historical buyback yield of Apple. If we calculate Apple's buyback yield based on the last 5 years, we come up with an annual buyback yield of around 4.3%. Because I want to be conservative, I only assume the future buyback yield of around 4%. Always remember that it's better to be surprised to the upside. Because we calculated the free cash flows to the whole company, which is normally funded by debt and equity, which bear different costs, we have to calculate a discount rate reflecting those cost differences. To do so in our simple DCF, we simply enter Apple's current market cap, its interest-bearing debt and its interest expenses. Now we can finally calculate the annual rate of return Apple would offer if we were to invest right now based on our assumptions. To do so, we simply adjust the cost of equity, which is basically our internal rate of return, until the number in the green box is equal to Apple's current enterprise value per share. When doing so, we come up with an IRR, so basically our annual rate of return of 12.3% based on our assumptions. So that's it for today's video regarding Apple. Please feel free to ask any questions in the comments and leave a like if you enjoyed the video. Please always remember to do your own research, your own due diligence, and never to simply trust a guy on the internet telling you that there might be a potential investment opportunity. See you next time.